Even prior to the Russian invasion of Ukraine, emerging market economies were facing some pretty difficult headwinds. Many of these countries had been particularly hard hit by the pandemic, and by and large have yet to fully recover from the shock. Now, in addition to these pre-existing vulnerabilities, we can also add in additional headwinds that include higher inflation, the tightening of global financial conditions, an economic slowdown, capital outflows, and the increasing probability of recession. Inflation has been rising around the world, and as a general rule, most countries will experience higher inflation, and in some cases significantly higher inflation in 2022 than they did last year. The IMF is projecting inflation for advanced economies at 5.7% this year, following last year's rate of 3.1%. And emerging market inflation is set to go even higher at 8.7% this year, following last year's rate of 5.9%. And food and energy price increases have been particularly striking. And unfortunately, this is the most detrimental to many emerging market economies who import these goods and whose large share of disposable income goes to paying for these goods. According to the Primary Commodity Price Index, which tracks global commodity price changes, food prices have increased by almost 50%, with energy increasing even more than 120% from the fourth quarter of 2019 and the first quarter of 2022. So higher inflation has led to a host of changes in central bank policy. Banks are starting to reverse their extraordinary monetary policy that has been in place since the pandemic. And as a result, since the start of the year, financial conditions have tightened significantly across most of the world. To date, central banks around the world have made almost 200 interest rate movements, with all but 6 of those decisions being to increase their policy rate. And of those 6 decisions to lower rates, 1 has been by the People's Bank of China, 1 by the Central Bank of Uzbekistan, and 4 of the 6 were by Russia. And just to kind of put this into perspective, in 2021, there were 127 decisions in total for the entire year, and now we have almost 200 for a little over a half a year. Higher interest rates have huge implications for debt sustainability as debt levels in many countries rose during the pandemic. The pandemic forced governments to borrow money to help deal with the detrimental social, health, and economic impacts. Governments were forced to shut down large portions of their economy, resulting in lost tax revenue at the same time when spending needs were elevated. And for emerging market economies, much of that increased spending was either funded through concessional lending with institutions such as the IMF or by issuing new debt on the capital markets. Emerging market sovereigns issued almost $3.5 trillion of debt in 2020, which is about 35% higher than the average that they had during the previous 5 years. And during this time, the number of emerging market sovereign credit ratings downgrades were also taking place due to poor economic prospects and strained budgets. So not only is the amount of debt increasing, but the cost to finance the debt is also increasing due to these deteriorating credit metrics. But at that time, interest rates were relatively low, but now that rates are increasing, this really does complicate matters. And this is particularly true if the debt was denominated in foreign currency or if the debt was short-term in nature. If the debt was denominated in foreign currency, particularly US dollar, it makes paying the debt back more expensive. Short-term debt is also more expensive because it will need to be refinanced at rates that will be likely much higher. And just a quick note on the strength of the US dollar and safe haven assets in general. There has been a large capital outflow for many emerging markets due to the general risk aversion of many investors to emerging markets. And the impact is the access to funding that many emerging markets will become more expensive for the countries as investors do require a greater yield to take on risk. Higher inflation, the tightening of global financial conditions, and the uptick in general items such as food all feed down into everyday people's lives. And the condition we are seeing in some of the emerging market economies are deteriorating and have the potential to deteriorate further. Government spending will be constrained by the high amount of existing debt, the lack of current fiscal space, and the access and affordability to borrow on the capital markets to help the populations. Unfortunately, this might result in increased protests, early government elections, and the potential for political regime change.